Dividend stocks, Maui, Hawaii, what do these two have in common? A whole lot. This is Ian from PPC Ian. I am vlogging here about dividend stocks from the Westin Nanea, Kaanapali Beach in beautiful Maui, Hawaii. I'm on vacation right now with my family, and I want to talk about some wisdom as it pertains to investing in dividend paying stocks. In particular, I want to discuss today the difference between buying stocks that are on deep discount value versus paying a fair price for premium quality stocks. If you've been following my channel for a while, you know that I just purchased some shares of Honeywell. I did a starter position. I started really small because I expect to average down over time. I expect over time that the price of Honeywell will become more and more attractive, and I want to average down over time. But the reason I got started is I want to put my foot in the door. I want to have a line in the sand, if you will, as it just gets me in the game with that stock. And I consider Honeywell a premium stock that I'm paying a fair price. I'm paying a 20 forward PE for this premium stock, and I am happy to do that. And I want to share in today's video why I am happy to do that. I'm actually going to start off with an example today, which is PepsiCo. If you've been following my channel for a while, you know PepsiCo is my #2 favorite dividend stock of all time. But you might not remember, some of you remember because I just did a tweet about this, but I actually said back in March and April of this year, March and April of 2019, that PepsiCo was one of my favorite stocks at the time that I was actively buying. I was actively loading up on this stock in the $120 range, and I got a little bit of confusion from the community on that one. They're, Ian, why are you buying this stock at such a pristine valuation? Ian, isn't that awfully expensive to pay for PepsiCo? And honestly, at the time it was. I've got my notes here, so I'm going to try to take a quick peek. Basically, when I was looking at PepsiCo and when I was averaging in the $120 range earlier this year in March and April, it was at near a 5-year high. And the stock was trading at a forward PE of 22.12. But you know what I said? I said at the time, this is a strategic company for me. This is a very premium stock. This is a stock that I want to buy and hold forever. It's my #2 favorite stock. I want to bring it to size in the portfolio. I want to bring it up to a 6 to 8% weighting of my overall dividend portfolio value. And so it's really strategic for me. And so I just said, look, I'm paying up for quality. I want to buy it. I understand that I'm paying up for quality. People at the time were like, Ian, you're paying too much. You shouldn't be doing that. Well, fast forward right now. Right now we're in October of 2019, and PepsiCo just released earnings, and they had a fabulous earnings release, just a remarkable earnings release, and it has catapulted the stock to new heights. And so right now, PepsiCo is trading at $140.28, and it is up 15%. It is up 15% from that range where I was accumulating just earlier this year, that range where everyone thought it was too expensive. And so the PE, by the way, now on a forward basis is an astounding 25. So it's at an even higher valuation than it was at. But you know what? I'm so happy I bought more PepsiCo back in the 120s. And quite frankly, I don't know if I'd be buying here. It's a little bit too frothy, but this is a perfect example of paying up for quality and how sometimes paying up for quality, it's okay. And I think a lot of dividend investors, they're kind of one of two schools. They either just pay up for quality and only buy quality like stocks like PepsiCo, or they're deep discount investors. They're deep discount people who only buy stocks on deep discount like AbbVie and Altria being two current examples. Personally, I like to mix and match all of the above. So I have stocks like AbbVie and Altria, I'll talk about that later, that I have purchased recently, and I bought them at deep discount value. I'm already up substantially on some of my AbbVie tranches, but I mix and match. I also buy stocks like Honeywell and like PepsiCo at fair valuations, and I'm doing fine with that strategy as well. And so I want to talk about all of the above today because I think it's okay to mix and match these strategies. And I think sometimes dividend investors, they feel that they have to go into one or the other camp. They have to only do value or only do quality. I'm here to say that I do both, and both have worked for me. Quite frankly, sometimes you see quality on deep discount. So it's rare, but sometimes you get stocks like a Honeywell on deep discount. I would say the current example of that, one that I've been actively buying, is 3M. 3M right now is a perfect example of a company that is quality company, growing company, but it's starting to get on discount. Now, would I say deep value discount? No, it's still at a pretty high PE, but relatively to where 3M historically trades, maybe that's a good example of such. And so get ready, longest intro ever for a really exciting dividend investing video right here from Maui, Hawaii. So being my number 2 favorite stock of all time, PepsiCo, I wanted to start off the video today and just talk a little bit about PepsiCo and their recent Q3 earnings release. By the way, if you're curious about Maui, Hawaii, we come here all the time. It's literally our favorite place on earth. I'm staying this time at the Westin Nanea Villas. I'm going to do some footage at the end of today's video where you can get some insights into what our vacation has been like, and you'll get to see some video from all over the island. But right now I'm literally under a tree, late afternoon, trying to capture some good sunlight in a relatively quiet space where I can film this video. So I'm right here on Kaanapali Beach, not far from Westin Nanea. If I actually turn around here, you can kind of see it. There it is in the background. So that's where we're staying and enjoying it because it's real quiet, real nice here. Big rooms, lots of amenities. We're in the 2-bedroom villa, which is perfect for families with kids. And we have 2 kids, and so it's working out great. And we're here with my wife's parents as well, so we're really enjoying that time together with family. And so I want to talk here about the PepsiCo earnings release just a little bit. And it's funny, I'll tell you, when I'm here in Hawaii, you always get thinking, and it's kind of hard. It's hard. Once I'm on vacation, I'm totally in vacation mode. I literally have trouble doing my job or doing work, and YouTube, it's a job in a sense, but it's also a passion or a hobby. And so I do apologize if the video's not quite as polished as they normally are. This is totally vlog style, but thankfully I got a new selfie stick and microphone for travel, so hopefully it's going all right for all of you out there. But please bear with me. I know it's not my normal production quality, but hopefully the knowledge there shines through. But what I'll say, by the way, what you see behind me now is the Westin Villas, the Kaanapali Ocean Resort Villas. That's the north towers on that side behind me now where I'm facing. Anyways, what I want to talk about when I'm in Hawaii, I just start thinking about the big picture, and I'm kind of thinking, look, I want to set the stage here with my investing, with anything in life. I'm looking honestly 100, 200 years out. And so when I start looking at things that way, I start looking at things from that perspective. When I talk about this whole discussion of, hey, Ian, why are you buying Honeywell at these pristine valuations? Same question I got on PepsiCo back in March this year. Why were you doing it? Quite frankly, Pepsi, maybe it didn't go up, maybe it could have gone down instead. Quite frankly, I didn't care because I look at Honeywell, I look at Pepsi as quality, and the way I honestly really look at it is 200 years from now, when future generations are holding these assets, or quite frankly, some of the assets may be used for charitable contributions. Are the foundations, the charities, are they going to care whether, I bought on deep discount value or not? No. What I'm trying to do is get buy and hold forever stocks that I want to hold forever, that are the best quality companies around. And so if I'm paying a little bit extra, when I look at 200 years out, I just don't care. And so obviously I want to use a lot of my dividend income to fund our living expenses and one day completely live off of dividends. But my aspirations, they're greater than that. I'm looking multi-generational. I'm looking towards the future generations of the family. I'm looking also towards the future of humanity and charities, charitable contributions and such. And so I'm looking at a really broad picture out there and how I can make the best possible impact on our world. And when I look at things that way, it just makes it so much easier in terms of nickel and diming, market fluctuations and such. And so that's why I felt so comfortable buying shares of Honeywell, even though they're towards an all-time high. It's okay because look, 200 years from now, am I going to be happy with that? Future generations going to be happy? Heck yes. And so that's the way I look at it. Anyways, I want to jump right now into PepsiCo. So what came out of this Q3 earnings that just has helped drive this stock up so much? Well, the organic revenue. Organic revenue is so important. It's a constant currency revenue. It's looking at core products. It's not counting like it's looking at internally generated returns. It's not looking at growth through acquisition, for example. It's looking organically, what did they really accomplish year over year? Well, in Q3, the organic revenue, it totally exceeded analyst expectations. I actually have that on the next page in my notebook here. I'm trying to handle my selfie stick one hand, notebook the other. But basically what Pepsi, they beat on organic revenue in Q3, but they also reaffirmed in 2019 that they are going to meet or exceed 4% year-over-year growth. And so this is kind of an old world company. It's a company that builds snack foods and drinks, traditional products, consumer packaged goods, consumer non-cyclical. They are doing just fine. They are growing like crazy. Also, one of the things that they highlighted is that they're doing really well in cost savings. They've derived $5 billion worth of cost savings, and the last $1 billion of that cost savings program comes to fruition this year in 2019, and all systems are go. It looks like they're doing well against those targets, which is helping the company from a profitability standpoint. And so there are some real innovations that are coming out of the company now that are helping the company. One of those that I was reading about is called Gatorade Zero. I'm not a big sports drink person or Gatorade person, so I don't know much about that, but I'll tell you what I am. I'm a big water drinker. I drink a lot of water. And their bubbly brand, this is the brand basically that is displacing LaCroix. So if you're a LaCroix fan out there, shout out, I love it too, but I like bubbly even better, and bubbly is totally displacing it. And so that's a PepsiCo innovation, and so I'm excited that they own that brand. Now, one thing worth noting, I'm just jumping around here vlog style, PepsiCo, it's up 25% year to date. The S&P 500 comparable over the same time period is up 16%. And so one thing I want to highlight here, I get this all the time, Ian, you can't possibly beat the S&P with dividend stocks. Ian, you can't possibly beat the S&P if you're not in technology. Well, the fact of the matter here is PepsiCo is totally not a tech company. It's beating the S&P handsomely. And so shout out to management at Pepsi. You guys are doing amazing. Now, here it is. Organic revenue in Q3 was up 4.3% year over year. The analyst expectation was 3.4%. I think this is the number one metric that catapulted the stock forward in the last few days, is the fact that they surpassed the organic revenue estimates. And so good on you, PepsiCo, for doing that. Core earnings came in at $1.56 EPS versus $1.50 analyst expectations. So on the earnings per share side of things, they're beating the analyst expectations as well. So nice to see that. I was reading that Frito-Lay is really strong. It makes sense. Snack foods is a great category to be in. This is a bright spot. A lot of these companies, these consumer packaged goods, consumer non-cyclical, in the food and beverage space, they've faced some weakness. One of the areas where they've actually had a lot of value, where they've done quite well, is in the snack food business. And so I love Frito-Lay. I love that division of PepsiCo. It's one of my favorite reasons for owning the company, and Frito-Lay is doing really well. Also, they were highlighting that US North America was a little weak. I think especially on their core beverage business, but international, especially in Latin America, super strong. And so it was really nice to see that trend as well. So those are just some of the metrics. Now, you may be thinking, why is Pepsi getting driven to these astronomical heights in terms of price per share? Well, I'll tell you something. The interest rates right now are at a historical low, and I don't think interest rates are going up anytime soon. In fact, there's talk that they may go even lower. The problem is government debt, corporate debt, national debt is at all-time highs. And we're kind of in a position as a company and as a country, and quite frankly as a global economy, where it's going to be really difficult for Federal Reserve banks to raise interest rates at this point. So we're in kind of a predicament, if you will. Now, there's talk about all types of stuff. There might even be a debt jubilee at some point where the debt is forgiven. Who knows what will happen? But what I believe at a macro level is that the interest rates, they're probably going to be staying low for a while. And so what does this do? It drives up the prices of bonds. It drives down bond yields. Bond investors now are wondering, where can they possibly go to get any kind of yield? Well, where are they going? They're going to blue chip equities that pay dividends, like PepsiCo. In some respects, these dividend growth stocks are becoming the new bonds. And so that's, in my opinion, why you're seeing some of these PEs go higher than ever before. Why, quite frankly, they may stay high, and quite frankly, that's why with Honeywell, I said enough is enough. I'm putting a line in the sand. I'm not going to take on undue risk and build my whole position here. Heck no, I'm going to average in over time, but I'm going to put my line in the sand and get started, because I don't know what the future holds, but I do know it's one of the best companies out there. It's an amazing company. I've wanted to own it forever. And so at a certain point, I just got to do that. I just got to go for it. And that's how I look at things. It's who knows what's going to happen with the macro economy. And again, 200-year time frame here in Hawaii, thinking about the big picture. It's a lot different than when I'm home doing my day-to-day thing, looking minute by minute, hour by hour, how I'm going to get through the workday, etc. It's good to take these types of vacations because you can think about things from a really broad view, and it makes me feel even better about what I'm doing with Honeywell. Now, Honeywell, in my opinion, it's like PepsiCo in certain ways. It's kind of like that. I feel like I'm paying a premium price for a premium quality company. That being said, it's different than PepsiCo in other ways. It's almost like 3M in other ways. And what's happening here is we're in the late stages of this economy and of this economic cycle. And one of the first things to go at the end of the economic cycle is the B2B companies. It's the business-to-business companies. It's the industrials, if you will. It's companies like 3M and Honeywell. And so I'm not going to fool myself. PepsiCo, it's evergreen. Any economy, people need snack foods. Any economy, people need to eat. And I love that about Pepsi. It's so defensible. It's why it's my number 2 favorite stock of all time. Now, the downside with these industrials, quite frankly, is they are cyclical. And in economies like this, especially heading into the next 5 or 10 years, I believe we could be in a prolonged downturn when it comes to these types of cyclical companies. And so I have to be careful. I've been using that to my advantage with 3M. I bought and I've been averaging down ever since, and I love it. I hope it stays low. I hope I have more opportunity to continually average down. That's how I do things. And in some respects, I feel like Honeywell, it's going to be the same experience. And so it's kind of I have mixed emotions on Honeywell. In some respects, maybe it's like Pepsi, but in others, quite frankly, it's probably more like 3M. But I am cool with that because I just have a starter position and I'm going to keep averaging down. And hopefully I'll have some time to build up my position at progressively better prices. And that's how I like to do things. It's not always how I do things. AbbVie, for example, I timed the bottom and I built my whole position pretty quick in what I believe is the bottom for AbbVie. Maybe I'm wrong, but I believe we've seen the bottom in AbbVie, and I took big advantage of it. I backed up the truck. I was buying with 2 hands, digging in there and buying as much AbbVie as I could. I built my whole position quicker than probably I've built a position in a while. And I did it because I had to, because I saw value. Quite frankly, that's not a premium company. It's more of it's a good company, but it's not premium the way I would say Honeywell and 3M are. Anyways, that's how I think about buying stocks. So again, there's different types of stocks, different types of strategies for acquiring them. And the takeaway for you at home is figure out which strategy or strategies works best for you from a buying perspective. I'm happy with all of the above. I'm happy with the paying up for premium. I'm happy for buying high and averaging down into my whole position. And I'm happy with those stocks where I'm just buying deep discount value. And so I do all of the above. You guys can check out a link in my description below for my complete 43 stock portfolio. And on Honeywell, by the way, just some stats. I bought at 168 and change, 20.75 2019 PE, 2.14% yield. A lot of people saying, Ian, you're not getting enough yield out of this. I could care less about the current yield. The compound annual growth rate of their dividend last 5 years is about 15%. per year on average annually. And so that'll probably slow down, but their payout ratio is low enough where I think that will continue for some time until the payout ratio gets a little bit higher. And Honeywell's very committed to the dividend. I'll link to my last video in the description below so you can learn more about that. Talked about it at length, but certainly paid for quality. Now I want to talk though, I'm not only paying up for quality, I'm not only paying high and then averaging down into building positions like 3M and Honeywell, but I also do the deep discount thing. And so I want to give some examples there. If you follow me on Twitter, you probably already know a lot of this, but Altria, I originally bought way back in the day. One of my best buys of all time was buying that thing in the $15 range. I think my first tranche was 15.99, so I got a low cost basis. But I recently bought more Altria at $42.50. That is a 7.9% starting dividend yield and a 10.15 forward PE. I bought into the value, bought into the drama. A lot of people ask me, Ian, what do you think about what's going on with the electronic products, with all the drama out there? I'm not worried in the least. In fact, I think this is a good opportunity. At the Juul subsidiary, they actually now have an Altria executive who went in to head that up. What do you think is going to happen here? I wouldn't be surprised if Altria ends up owning that whole company at some point. Also, they're bringing their IQOS product, the heated product, to market in the US quickly. That got FDA approval a while back, but I think they're using this drama that's happening right now to bring that to market even quicker. And so am I worried about the drama in that market? People ask me, has anything changed since you did that flow chart? I'll put it on the screen. I did a flow chart in some recent videos. No, nothing has changed since then. I continue to like it, but I'm careful because my allocation to that sector is high. It's a really high allocation. And so from a risk mitigation standpoint, I need to be very careful about where I allocate dollars. And I already have a huge allocation, but I'll continue to probably pick up more. I'm certainly reinvesting all my dividends in that space, the sin stock space, until the equity prices recover. And so anyways, though, that is a big contrast to my buy in Honeywell, for example, and my buy in PepsiCo even back earlier this year. Let's talk about AbbVie. I love this one. I bought all over the place. I was buying a lot of tranches, but one of my tranches was at 66.98. That marks a 6.4% starting dividend yield and a 7.59 forward PE ratio. And so what's funny is that was just a month ago. That was in early September 5th. Now AbbVie is already trading at $74.66. So in just a month here, we are up 11% on that tranche. I'm up 11% on that tranche in one single month. And this is what's fun about value investing, but quite frankly, it's also fun about paying up for quality. J&J is going through the roof on capital appreciation. So is AbbVie, and I think we've seen the lows in AbbVie. I could be wrong, but that's an example of me going in and buying value, and I'm happy to do it, buy and hold forever. How can I not like a 7.59 forward PE? They have a ton of risk. I've highlighted that at length in my AbbVie videos. By the way, a quick hack here. If you ever want my opinion on a particular stock, just go to YouTube and type in PPC Ian, all one word, and then type in the stock ticker. YouTube is really smart. It'll usually surface the appropriate videos for exactly what you are looking at or looking for. And so just a little hack there for all of you at home. And so how do I want to bring this thing home? Basically, my take on all this, I want to talk about a few things again. 200-year time frame. I think a lot of people here in the community are thinking too small, you're thinking too short term. Hey, just my personal opinion. Go home, think about your time horizon, think about what that means for you, for your stock acquisition strategy. For me, when I come someplace like this where I can think clearly, I can really put my life plan into motion and I can kind of think it through better than I can at home, it puts this thing into perspective. And so I'll tell you, there was someone else in the community, Dividend Grinder put this in one of his videos long time back, and he just said, hey, at a certain point there's a lot of analysis paralysis, and if you like something, just buy it. I kind of subscribe to the same thing. That's why I bought Honeywell. At a certain point, I've analyzed it. I did the in-depth fundamental analysis in the last video. Not the best value here, but you know what? I want it, I bought it. And so you come somewhere like this, Maui, it just kind of puts that type of strategy into perspective as well. that's what it's all about. Something else I want to talk about, again to summarize, is there's a difference between paying up for quality and value investing. They all fall under the umbrella of dividends, quite frankly, and I mix and match the strategies. I have 43 stocks. I like to diversify. Last, I get some questions recently about diversification. Are you over-diversified? When are you going to stop? You have 43 stocks. Personally, I'll tell you, this is kind of where I'm drawing the line in the sand for my own stock acquisition. I'm at the point, I bought a lot of them, and I bought a lot of them, quite frankly, I would say I got to be honest with myself. That's what's great about YouTube, great about the community here. I love you all. Thank you for the subscriptions, likes, comments, all of that. And we are now, 38,000 of us strong dividend investors, just amazing. But I got to be honest, that what's great about the community is it keeps us honest. The Facebook group, I'll link in the description below, keeps us honest. One of the reasons I'm buying so many stocks is honestly because of this channel. I want to have stocks to review, and so I sometimes have to be honest with myself that if I didn't have this channel, would I own as many dividend stocks? I am not so certain. And so I am okay with that, but at the same time, full disclosure at the community, that's where I'm at. I'm happy with it. One of the silver linings in having so many positions is I'm at the point in my life right now where I want to have more stability in the portfolio. Portfolio is getting bigger. Portfolio needs to weather any storm. It needs to weather any size wave, although the waves out here on Kaanapali Beach right now are pretty small. Afternoon here. Perfect beach for kids, by the way. The waves can get big sometimes, and so you got to be able to weather any storm. And so I like having portfolio 43 positions to do that because I have representation from all the sectors. Quite frankly, I was underweighted in industrials, and so I have two choices. Do I add more money to something like a 3M or also add Honeywell, add money to both? I chose to go the Honeywell route plus adding to 3M. I need to build up my industrials. I'm overweight in consumer non-cyclical consumer type companies. I'm consumer packaged goods. I am overweight in that type of stuff, and so one of the reasons I've been buying more stocks over the last year is to even out my portfolio in the sectors where I don't have a lot of representation. And there's still sectors where I don't have a lot of representation, but it's all good. I can't cover it all, but with the 43 I got now, I feel pretty good. Will I add one or two more over the years? Probably, but I'm going to ask you in the community now to hold me accountable. I'm kind of at that point where, hey, I'm all good on the positions I got. Don't need to have too many more positions in the dividend stock portfolio, but I sure feel good about the diversification. And you may be thinking, what's your strategy with diversification? Mine comes down to the size of my portfolio and where I'm at in life. Late 30s, big portfolio, only getting bigger. I feel good about the diversification. A little bit bigger of a portfolio, maybe say 5 stocks bigger than it would have been without YouTube, just because the community, the producing videos, producing content, sometimes it entices me just to maybe buy more stocks than I would have otherwise, but I would have still had a big diversified portfolio. But if I were just starting out, I certainly wouldn't do that. If I had 10,000, for example, I would have probably 5 stocks. And so, and quite frankly, to get up to having more and more, it dilutes some of your best stocks. So, but by having more stocks, for example, it means PepsiCo is a smaller percentage of my overall portfolio. And so just something that I always have to keep in mind. But I feel good about the diversification from a personal standpoint, but it may not be what's right for all of you at home. And so you have to think about your own strategy, where you're at in life, what your goals are, how much risk you can tolerate, and how close you are to using dividends. I'm already using dividends to pay some of our bills. Because I'm at that stage, I need to have the stability, and I'm getting 173 paychecks per year from dividends. Now with Honeywell, that is up to 177 paychecks per year, and so that is really exciting. All right, everyone, thank you for joining me here in Maui. I'm going to do my disclosures now. In terms of full disclosure, I am long PepsiCo, ticker symbol PEP, Honeywell, ticker symbol HON, 3M, ticker symbol MMM, AbbVie, ticker symbol ABBV, and Altria, ticker symbol MO. I own all of those in my personal dividend stock portfolio. Also, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go home and invest in the stock market or anywhere else, please consult your licensed investment advisor first. And now, before I end today, I'm going to share some footage from our vacation so you can get a feeling of why we love Maui so much. And honestly, another take home for everyone there is, could I save money by not doing these vacations and have more money in stocks? Absolutely. But the value from these types of experiences is so timeless, so valuable, so life-inspiring and changing that I always feel good paying for these types of vacations. Best investment you can make, and so some more wisdom for all of you at home. I truly love you all. Thank you for dealing with the shaky camera here and the lower video frequency. I'm trying to make my videos a little bit longer, a little bit more meat to them, so there's a little less frequency, and also I got a little slowed down by planning and preparing for this vacation, but I'll be home soon enough, back in the studio with the brick wall behind me. I love you guys. I will see you in the comments section below and in the next video. All right, everyone. Happy dividend investing.